Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll bring you the breaking economic data you need to know as job openings and manufacturing numbers are crossing the wire. Plus, investors kicking off second quarter trading, but will the market mirror the volatility that we saw in the first quarter of the year? We will discuss. Also, OpenAI raising $40 billion in its latest funding round. We'll break down the demand picture for artificial intelligence and if the bubble has burst for the once dominant trade. Half an hour into the start of U.S. trading, let's get you a check on the markets here. Taking a look at the major averages on our screen here. The S&P 500 down about 0.3%. Tech-heavy NASDAQ down about 0.1%. It had flipped green momentarily a couple of moments ago, but we are seeing it back in the red this morning. Let's take a look at the bond market, though, because I wouldn't be surprised if we are continuing to see yields falling to the downside off the back of this economic data that is crossing the wire right now, which I'm going to get to you now. So we have JOLTS, job openings, labor turnover survey here. The JOLTS headline number coming in just below estimate. So coming in just shy of the estimate here at about 7.5 million. We have the JOLTS jobs opening rate coming in at 4.5%. That is just a tick below 4.6%, which was the survey estimate here. The jobs opening rate, again, 4.5% for the month of February versus 4.7% in the prior month. Interesting to look at the quits rate as well, coming in at 2%. Just a few less people seem to quit this month, 3.1 million versus the prior month of 3.2 million. Interesting to also take a look at layoffs in this environment. The layoffs rate coming bang in line at 1.1% versus the 1.1% estimate. We also had 1.79 million workers fired or laid off. That was just a tick above the layoffs we saw for the prior month. I do want to see if I can go ahead and also break down the ISM manufacturing data falling to 49. That was below the 50.3 estimate here. New orders also falling to the lowest reading since May of 2023. Prices paid, this is going to be key here. Highest reading since June of 2022, rising to 69.4 versus 62.4. So again, that prices paid number critical to watch. We also saw employment falling to 44.7 versus 47.6 in the March ISM manufacturing data. All right, we are going to break down the story behind all the numbers I just spit out for you. I want to bring in Kristina Hooper. She is the Chief Global Market Strategist at Invesco, a certified financial planner with over 20 years in the industry. She'll be here with me for the hour. Kristina, I know I just broke down a lot of numbers across JOLTS and ISM manufacturing. What's standing out to you this morning?
So I think what we're getting, certainly from the ISM data, is that the risk of stagflation has increased, right? We've seen a deterioration in manufacturing activity at the same time we've seen prices paid increase. And while the JOLTS data is pretty stable, what we do see is an uptick or a downtick, I should say, in jobs created. And that's important because there's been this delicate balance where job creation has been relatively low, but so have layoffs, as Chair Powell noted. But if we think we're going to see layoffs increase, which I very much anticipate going forward, and we continue to have pretty tepid job growth, that's a problem. And again, underscores that message that the risk of stagflation, or at least deceleration in the economy and potential recession, is increasing.
What drives that layoff increase in your view?
So I think it's a combination of things. What we saw in the previous bout of, shall I say, tariff wars, is that there was a chilling effect on hiring, on business investment. Now, it went away rather quickly, but if tariffs were to remain longer term this time, that would certainly be problematic and create economic headwinds. But I actually think the bigger issue is DOGE and government cuts. I think I think the market is underestimating the impact on the economy because there are very, very significant ripple effects that occur when you start to cut government programs and government employees. Contractors are also getting cut. It has an impact on economies. And I think just like government spending has multiplier effects, cuts in government spending have very significant multiplier effects.
So given all of those headwinds that you mentioned, we had an investor tell us earlier this market isn't even accurately priced for tariffs. Are they accurately priced for the risks of DOGE then?
I don't think so.
Yeah. And what would that look like for repositioning to start to look like, okay, this market's starting to believe this administration?
Well, I think the hard part is that we just don't know how much further the administration will go. It could very well be that the administration looks at polling and says, gosh, DOGE is very unpopular, or tariffs are very unpopular, let's pivot. And that could be the end of it, and so markets could be fairly accurately priced. But if we were to continue down this path and we were to see very significant government spending cuts, or if we were to see tariffs in place for a long time, that would certainly mean that today markets are mispriced. We just don't know, though.
We just don't know. Yeah, that is something that hopefully we'll get some clarity on this week or at some point in the future. We will be covering it all here at Yahoo Finance. Kristina, stick with us for the hour for more analysis. I do want to turn now to the Federal Reserve. We've already heard from a few FOMC members this week, and we're getting a lot more, including Fed Chair Jay Powell coming up on Friday. Yahoo Finance Fed correspondent Jennifer Schonberger joining us now. And Jennifer, I know that you spoke with the New York Fed President John Williams yesterday in a fantastic interview, and you were able to get some more clarity from him about his reaction to transitory re-entering the conversation. What stood out to you?
Yeah, thank you, Maddie. So 2 things stood out to me. 1, uncertainty reigns, and 2, we're going to see higher inflation and lower growth, to Kristina's point. When it comes to uncertainty, what struck me was that I asked him, are you increasingly seeing a chance for fewer than 2 cuts this year? And he said to me, Jennifer, you're asking me to look out to the end of this year. The future is so uncertain. And that told me 2 things. 1, if we do get cuts, we're not going to see that until the fall. So a June rate cut, probably not on the table, as the market is pricing in. And 2, they don't have that much confidence in their forecasts because visibility is so poor right now because we just don't have any certainty about the policies coming out of the administration. And even if we do get a plan, or when we get a plan, I should say, tomorrow from the president, we could see several rounds of revisions from that, which creates further ripples of uncertainty. Now, the second thing you asked about, inflation, he does see the potential for prolonged effects, specifically the fact that we can see tariffs on intermediate goods within the supply chain. He says that could take up to 2 years to ripple through the system. So transitory or not, I don't know how you define transitory, but it looks like the potential for inflation to be with us a little bit longer than just this year.
Yeah, Jennifer, just for those who weren't able to listen to your interview yesterday, we just want to play a quick clip from that for our viewers.
Those increased costs for American producers, it takes some time for those to get into consumer prices and show up in inflation. So it's definitely a channel that past history teaches us may take a few years to be fully seen in the data.
Yeah, and Maddie, you heard there President Williams basically speaking to the notion of prolonged effects. I did ask him, we're already at 2.8% on the Fed's preferred inflation gauge, which was an upwardly revised forecast that we saw at the last meeting. Is there upside risk to inflation? He said, absolutely. But again, the visibility very poor. I did also ask him, are you willing and can you assure Americans that you're not going to allow stagflation all of the 1970s to take hold? And he said, absolutely. So Kristina, I wonder, to your point, you say that we are facing stagflation, or maybe a mild version of that. Certainly the ISM manufacturing seemed to point to that. When you look at prices versus the actual manufacturing, what are your thoughts on that?
Well, I certainly think the risks have grown. I don't think it's a fait accompli. That's the key takeaway for me, and that's why there's so much uncertainty, is the administration could certainly pivot, and we could be in a very different place where stagflation risks decrease. That's why it's fascinating to me to have seen the Fed actually come out with a dot plot last week. I mean, I guess they felt they had to because they come out with it every quarter, but this was a very difficult, and it was an admittedly difficult exercise. Chair Powell said that.
Right, exactly. Right, yeah.
But I was impressed that they even penciled in 2 rate cuts for this year, because who knows? I mean, given, depending upon the policies we see and the impact, we could see hikes, we could see them sitting on their hands. I do think it's important to recognize, though, that the mindset of most Fed members is they don't want to be the next Arthur Burns. They're a lot more afraid about inflation than they are about a recession. So they don't mind being.
I agree with you there, because I asked Williams, do you see higher risks to inflation in the near term versus risks to growth and employment? He said, I can't answer that question, it's too hard. But I really think that they are worried about inflation. They still have an inflation problem coming into this before we're getting the most aggressive slate of tariffs that even kick in. We were already seeing inflation bubble higher. So.
And doesn't it make sense, too, that recent history would somewhat impact them, right? That there's this idea that they dropped the ball on the initial pop in inflation coming out of COVID. How could that not make you want to prevent that embarrassment from happening again, to put it kind of crassly? Yeah.
For sure, which is why I think there was like sort of stunned silence when Chair Powell actually used the term transitory last week in the press conference. Because
shaken investors everywhere. Yes.
Yes. But I think he's right, because if you actually go back to the first Trump administration and that bout of tariff wars, what we saw was that prices went up, but very, very briefly. So they truly were transitory.
Yeah.
And so that is perhaps the best playbook we can rely on, is what happened in the first administration. I think the fear is, though, that things could go very differently this time.
We're already seeing, though, tariffs that are 4 times the amount that we saw in 2018, 2019. So this is a totally different situation.
Well, go big or go home. But no, seriously, though, you could still have 4 times the amount of 4 times the size of tariffs. But if you pulled them off quickly, I don't think it would have any kind of lasting impact. The question becomes, how long will they stay on?
And we will be covering any potential developments that we get out of that on our special coverage on April 2nd for so-called Liberation Day, according to the president. Kristina, thank you so much. Jennifer, great to have you in our New York studio. Thank you so much for breaking down that interview with us. Coming up here, we are going to be discussing the price of implementing AI, and what's coming for the broader tech industry. That's next. OpenAI says it secured an additional $40 billion in its latest funding round, pushing the company's valuation to $300 billion. The funding round, led by SoftBank, is the largest for a private tech company in history, according to CNBC. Meantime, SoftBank is seeking a record $16.5 billion loan to help fund its ambitious AI investments, according to Bloomberg. SoftBank has teamed up with OpenAI, Oracle, and others on the Stargate AI venture with the goal of investing $500 billion into U.S. AI infrastructure over the next 4 years. The venture was announced back in January at the White House, though it had been planned since 2022. SoftBank has been seeking financing to the rollout and to the project, according to reports. The loan, which would be its largest ever, denominated solely in dollars, may also be used to fund SoftBank's latest investment in OpenAI. In an interview with executive editor Brian Sozzi, AMD CEO Julie Su discussed the surge that she's seen in AI investment.
The need for compute continues to be immense. We see that throughout all of our customers globally, and we're going to continue to invest strongly in this area because I think this is the single most important technology. I like to say it's the single most important technology of the last 50 years.
Thanks to the introduction of DeepSeek, the cost of AI has shrunk significantly, lowering the barrier to entry for smaller firms. Joining me now to discuss the outlook for AI demand and the broader space, we've got Jonathan Frankel. He's the chief AI scientist at Databricks. The company helps enterprises build and scale custom AI models. Jonathan, it's great to have you in studio. Thank you for being here. I am curious about how you are viewing the DeepSeek of it all, because from a market's perspective, we've seen a little bit of a sell-off in some of the big tech names since. There's a question about the kind of ROI of AI. What do you say to that question?
So I look at it 2 ways. I mean, the first is a question about what does DeepSeek mean for our customers? And the answer is it means more AI at a better price. It's the same thing with, I look at this new funding round in OpenAI, I look at, the Llama models, I look at our friends especially at Anthropic, where we just signed a deal where Anthropic models are now available on Databricks natively. The idea is let's give people more choice. Let's give people better technology. So my focus is just, on our customers at the end of the day. There's a bigger question of kind of, what does that mean for the broader ROI in AI? Mm-hmm. I think it's great. I think that if you make technology more cost effective, more people are going to adopt it. There are going to be more use cases that make sense and have ROI, and we're going to see more use of AI in general. So it's great for the space if cost comes down.
On the ROI of AI, which do you foresee as being more likely? Companies being able to use AI to be more productive and therefore cut costs, or companies being able to charge for their AI and that being a potential profit margin driver?
So I think the answer is yes. I'm seeing anything and everything right now. We're still in the discovery phase where people are trying all sorts of things, but with any productivity enhancing technology, it allows you to do 2 things. You can do what you did today or what you did yesterday, only cheaper. And it allows you to do entirely new things that simply didn't make sense before. I think there are certain things, like we can look at all these deep research and thinking and reasoning models that have come out recently. They're allowing people to do things that a human could not physically do, to read all the papers on a particular topic and develop a report on that. You can think of it as a productivity booster, but you can think of that as net new technology that was simply impossible before. A human couldn't do that in their lifetime.
Okay, so Jonathan, what we saw emerge in the last year plus is concerns that companies would slow down their investment in AI. And of course, I think that has only been amplified by what we've seen recently in terms of a big increase in economic policy uncertainty, which tends to have a chilling effect on all kinds of business investment. Do you see that happening?
No, I see a huge amount of investment in AI. I spend a lot of time, my title may be Chief AI Scientist. I spend a ton of time with our customers because I need to figure out what science to do. What I'm seeing is they're starting to get clear ROI from AI, and that means they're investing even more. I think more broadly, we can look at the state of the market today or the state of the market yesterday, but in 1997, if you had said, are we investing too much in the web or too little in the web? Look at where the web is now. Look at where the internet is now. Any amount of money you could invest looked like a great value back then, and the companies who really jumped in immediately got ahead and have stayed ahead. And I think the same thing is going to be true about AI. I'm looking at our customers who are tech forward, willing to take some risks and willing to try things. I think they're going to be the leaders in their categories going forward.
But to Kristina's point, there is this increased risk of a recession. Now, Goldman Sachs saying there's a 1 in 3 chance of us having that. Are your customers potentially going to say, well, if we're entering a recession, maybe right now is not the time to invest in the future web. Maybe we wait another year. Maybe we wait even 6 months just to kind of hold off and see where this economy is heading.
No, I'm not a macroeconomist, but speaking as an AI scientist hanging out with my customers, I'm not seeing any of that. I'm seeing investment and grow, and I'm seeing people finally hitting ROI. I think if we had talked about AI 2 years ago, there was a lot of question of is this a great demo, but what does it really mean in production? I'm seeing customers who have real products deployed where they're actually getting product market fit. And now the question is, how do they iterate? How do they build the testing and infrastructure necessary to ensure that this is working? And how do they figure out how to improve it? Mm-hmm. That's a sea change from where it was a year or 2 years ago, where people were still trying to figure out what to even do with this technology. So I think as long as people are seeing value, people are going to keep investing. And as long as people are seeing efficiencies from this, supposing that we do end up in an environment where, things are a little bit trickier economically, why wouldn't you invest in efficiencies?
Are you getting questions about policies from this administration from your customers?
At least not in my position. Again, I'm a scientist, so I'm really concerned with how we build the technology for them. Nobody's asking me about policies. Everybody's asking me about how to go faster.
How to go faster. So Kristina, why are we not seeing that in the market action? When you hear, obviously you are very bullish, Jonathan, but the tech stocks are driving the entire market down right now.
Well, perhaps, first of all, they're not hearing what Jonathan's hearing, right? They're just worrying. And I think also the bigger picture for tech stocks is that valuations are high. And typically when we see economic policy uncertainty go up, or really any kind of uncertainty go up, that creates downward pressure on those stocks with the highest valuations because they are arguably priced for perfection or near perfection. So I think this is just a natural phenomenon that occurs right now because, as we heard from different Fed officials, so many people, we just don't know what's going to happen this year.
We certainly don't, but I know that one area of the market where we have seen perhaps a little bit of bullishness, despite the negativity, is in quantum in particular. Jonathan, I wonder how you're thinking about the opportunities of quantum and supercomputers.
Unfortunately, I can't say a ton. My title is Chief AI Scientist, and you'll have to call our Chief Quantum Scientist to chat about that. One thing I know as a scientist is I stay in my lane and speak about what I know, and I leave it to the experts to speak about other things. I'm not a quantum expert, unfortunately.
All right, Jonathan, thank you so much for joining us.
Thank you for having me.
Making the time this morning. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. 1 hour into the start of trading, let's get a check on the markets for you. Taking a look at your major averages here, we are still seeing more selling coming in. You've got your S&P 500 off about 0.7%, the biggest declines that we've seen so far this morning. Your tech-heavy NASDAQ also taking up some losses here, down about 0.5%. Interesting to see more selling in the S&P this morning than the tech-heavy NASDAQ. I do wonder if we can flip the board over to the bond market. Wouldn't be surprised to see that 10-year still falling today, nearing that 4 4.10 level here. Interesting to see it continuing to move down, and whether or not the bond market is going to be driven by inflation concerns moving forward or stagflation concerns. Certainly something that we are continuing to talk about. We've still got Kristina Hooper with Invesco on set with us. Kristina, one thing that we were just talking about is how you model and look at the economic impact of every single policy position that we were hearing from the White House. And I loved the chart you showed me from the Congressional Budget Office on the multiplying effects of cutting back on spending. Walk our audience through that.
Sure. Well, I think it's important to recognize that different line items of government spending have different impacts on the economy. Some have less of an impact than others. Some have an impact that is very powerful. And so the CBO actually publishes on a relatively regular basis what the multiplier effect is for different line items of spending. And so I keep that tucked away in my notebook because as we go through government cuts, we have to recognize there is a negative multiplier effect. And so there could be very significant ramifications for the broader economy when, for example, we reduce transfer payments to individuals. Think about how powerful PPP was because it went to individuals. Now think if you cut something like welfare payments or something like that, that could have just as powerful an impact, but on a negative basis. And so it's something to keep in mind. Again, I think there's so much attention being given to tariffs. And it's not to say that tariffs are not creating economic headwinds, but I think what could create bigger headwinds is government spending cuts if they're big enough.
And it sounds like the economic deterioration could happen quite quickly if you combine all of those factors. So given that, I wonder to what extent you think the Federal Reserve is going to potentially be in a position where right now investors are saying, well, maybe you should cut because of tariffs, but then we're also going to have inflation, so maybe they should be hiking. It's a tough environment for them.
I would not want to be in the seat of a voting FOMC member for sure, because they have so many considerations. And I think first and foremost, the ghost of Paul Volcker looms large over the Fed. They don't want to be another Arthur Burns. They want to be the folks that stop inflation because they view that as a very, very significant problem. They're less concerned about being the next Herbert Hoover. They're not as concerned about a recession. Now, if it were to be a deep recession, I think that would certainly change, or if a recession seemed imminent, that certainly would change their priorities and their focus. But as we sit today, as we sit here today, again, I'm impressed and amazed that they penciled in 2 rate cuts this year because who knows?
Who knows? Yeah, to their own point, difficult to plot out the dot plot in this environment. We were talking also about the questions that we've been getting in just from friends and family. It's interesting when the stock market kind of breaks the fourth wall, and you can tell that stock market news is impacting and leading to questions for people who typically are not following the market every day like you and I are. What are you telling people in your life when they ask you what to do right now?
So I asked them, what is your time horizon? Is it longer than a recession? Is it longer than a presidential term? Is it longer than a decade? Because we did see sort of a stagnant decade for stocks in the 70s. My mom just turned 90 yesterday.
Oh, congrats.
Thank you. And I was thinking about it. She was born in March of 1935, March 31st. FDR was president. It was the midst of the Great Depression. Unemployment was 17.5%. And I think about all that she's lived through, 1940s tariffs, a world war, the assassination of a sitting U.S. president, the Cuban Missile Crisis, a pandemic, so many different things, Watergate, stagflation, all those things. I remember when my parents had a mortgage that was probably a 18% rate.
Wow. Yeah.
Think about all the opportunities that investors who've had a lifespan like my mom's could have walked away from the stock market, could have gotten spooked. In fact, I lived through it in the global financial crisis. I sat on a small endowment, and there were members of the investment committee in February of 2009 that wanted to get out of equities. And even though we had a long time horizon, think about an endowment model, that is the longest time horizon. And so we had a big argument over it, but luckily we stayed the course. But there were many who said, I can't take it, I'm getting out. They locked in their losses and they missed out on a recovery. It's amazing how stocks have this very funny habit of moving upward over time, despite some significant setbacks along the way.
Gravitational pull to the upside looms, and many millionaires are made after those times of recession and the recoveries after. So certainly something for our investor audience to keep in mind. Kristina, thank you so much. Appreciate it. We are going to get to Tim Fiore here because the latest ISM manufacturing PMI came in below expectations at 49, contracting in the month of March after 2 months of expansion. Slowing activity and rising prices suggest the U.S. could be heading toward stagflationary territory. For a deeper dive, I want to be joined by Tim Fiore. He's the ISM Manufacturing Business Survey Committee Chair. Tim, thanks for joining us. Talk to me about stagflation in this print. Is that what you're seeing?
Well, I think the biggest message in the report this month is that we're declining in revenue, or we're declining in output, and we're continuing to release people because we're not sure about the near term and moderate term future here. So that's the real story. This is if you look at the details on this, the demand side is still weak. We've got 3 or 4 demand indicators that are negative and heading in the wrong direction. And that's pretty much because of the uncertainty. We're not really sure what this whole tariff portfolio is going to look like. Hopefully this week we'll add some clarity to it and we'll be able to move forward, because whatever it is, let's get on with it. We're tired of studying it. There are so many different elements and variables to this thing. Here we are a day before release, and we still don't know the details of what tomorrow is going to look like. So, okay, let's get that resolved. The input side, we're stocking up on product to try to avoid tariffs, but it now kind of feels like these tariffs are going to be with us for a while. So at most, we're stocking up maybe a quarter worth of material. That will go quickly, and we're going to be into tariff material in short order here. Suppliers are struggling to some extent because we're still arguing about price increases, as well as probably some blockage at the ports because you have to pay before you can get your product released now. And then, like I said, I think the biggest story here is that our production is down, our employment is going down with it, and that's our investment really in the future, the employment. Remember how hard we worked to staff up in the last 4 or 5 years? Well, we're now going to be cutting into more serious bone here, I think, because we have been destaffing for over a year. And we thought that this would stop probably in January. And here we are now at the end of March, and we're still destaffing at a sizable level. The good news is we're not laying off, we're attriting down, which means that we're taking it slower and it's not as expensive. But, hey, the last thing on this thing, Madison, is if you did a normalization for the inventory number being high because we did the pull forwards, this would be in the range of 48, 48.3. And think of it that way. This is not a disastrous report, but it's not meeting the growth projections that we started the year with. And we started the year pretty confident. We've had 5 reports now since the new administration came in place, and we're pretty much where we were in October before the election. And right after the election, we were feeling really good. Our sentiment is getting worse. We're down to 1 to 2, meaning that 3 people, 2 of them aren't feeling good.
So Tim, this is Kristina. Just a quick question for you on what you think the bigger risk is coming through in the survey. Is it the uncertainty, the unknowing, or would it be if tariffs were significant and we were told they were long-lasting? What do you think is the bigger problem?
Well, I think it's the uncertainty, it's the unknowing, because we're all going to be in this together. If you're a U.S. manufacturer, if you're selling goods in the United States, we're all going to face the same issues. Some of us will have more serious issues than others, depending on what strategic decisions we made 10, 20 years ago, or even 2 years ago. All that stuff we tried to get out of China and put into Mexico might end up getting tariffed tomorrow. So I think the biggest issue here is the unknowns. Because as competitors, we're all going to be faced with the same issues. Yeah. So let's get in there and fight. Let's get on with it. Let's get on with it. And I think, as I said this morning, we heard the number of $600 billion of annualized tariff income that Peter Navarro has expressed, and I think he expressed the opinion of the administration. That's $600 billion being pulled out of the U.S. economy. Yeah. How does that not lead to a decline in demand? I don't know how it doesn't lead to that.
All right, Tim, we got to leave it there. Thanks so much for making the time this morning. Coming up, we break down key catalysts for the market in the second quarter. Stick around, that's next.
Wall Street's brutal first quarter was the worst for the S&P 500 since 2022. Worst March for the NASDAQ 100 since 2001, but it wasn't all bad. So let's take a look under the market's hood. I'm Jared Blickery, host of Stocks in Translation, and today we're looking at the first quarter. Definitely ugly here, and we can see this in the indices. And then we're going to do a little bit of a look ahead. But these are all the indices that I'm looking at here, starting with the S&P 500 equal weight. And in white, we have the March performance. And in Q1, that is the green performance. And they're kind of combined. So the March is included in Q1. But I just wanted to show you how everything is negative here. And that wasn't necessarily the start at the start of March just a month ago. But we can see the S&P 500 equal weight, that is doing not too badly. Then we have the Dow, that's just 30 stocks. And then we get the S&P 500 regular index, that's down about 5% in the first quarter. And then we get to the bad stuff. That is the Russell 2000 and the NASDAQ 100 and the NASDAQ Composite, all down about 7.5% or more. And it's really interesting because the Russell 2000 is small cap stocks, and those are doing pretty badly along with the NASDAQ 100, which is heavily weighted to some of those mega cap stocks. And you can throw the NASDAQ in there as well. And when you break it down by subject or by sector, you realize it's not all negative. I have some of the top performing sectors of the year here. And for energy, and again, we're measuring Q1 and also March, you can see energy is the only one that was positive in March, and its Q1 performance is about, 8-9%. Then we also have healthcare, utilities, consumer staples, real estate, and materials. Most of these are defensive. These are some classically defensive sectors. So when you see these outperforming, that is not necessarily a bullish setup, but it is not terribly bearish either, because I would remind everybody that when we head into a recession and when we really see that on the wall, we see everything getting sold off. And that's just not what's happening this year. So this is the first half of the sectors, but then I want to show you what changes when we start getting into the second half. Financials still positive for Q1, but definitely negative in March. And then everything is negative in both of these time periods. That is communication services, so that's Alphabet and Meta. Then we have industrials, you can think Boeing and Caterpillar and some others. And then tech, that is definitely Apple and Nvidia and Microsoft. And then consumer discretionary, by far the worst, down over 10% for the quarter. That is an Amazon and Tesla story. So in framing this around some of the mega caps that we have here, and I have the Magnificent Seven, again, everything underwater for both March and the first quarter of 2025. But Tesla really stands out here. And to be fair, we realized for a long time now that these are not seven stocks that are marching in order with each other lockstep. They each have their individual stories, but there does seem to be this theme of the ultra big. Those stocks that have done the best over the last few years have definitely gotten thrown under the bus. I want to go into some of the S&P 500 worst performers, and then we'll do best performers here. These are the worst. I'm going back to the beginning of March, and so we have one extra day since we're at the beginning of April here. This goes as to the close. Well, actually, this is real time, so we got a couple days. But just let me sort this by equal weight, and you can see the broad selling that we've seen in some of these industries. A lot of them are cyclical. So you see Super Microcomputer, that is a cyclically oriented tech stock. You got Target, you got a bunch of health, you got a couple of healthcare names, you got a bunch of retail names like Tapestry and Lululemon, HP, that's Enterprise, that's down 22%. And leading the way down is United and Delta. And those have just been, I'll show you a quick chart of United over the last year. You can really see how it's just fallen off after a really decent rally there. So let's close with some of the best performing stocks here, and I'll sort by performance as well. At the very top left is Dollar General. Now, is this recovery in the bull market going to be led by Dollar General? Probably not. So this is a kind of a hodgepodge of what's working here. But within there, we have some pretty strong defensive names in healthcare like United Health and so forth, and even an airline, which was Love, which is Southwest Airlines, one of the top performers in the S&P 500, kind of at odds with what was happening on the worst board. So you put it all into context, we have a bifurcated market, and we're looking for the resumption if those big guys can back the trend here. So tune into Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website, wherever you find your podcast.
All right, thanks, Jared. Stocks are mostly lower. The Nasdaq just turning positive after that weaker than expected manufacturing and labor market data. The growing trend of softening data as well as tariff uncertainty weighing on markets here, causing the S&P to see its worst first quarter in 3 years. As we enter Q2, what are the catalysts for the market? Joining us now, Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management, and of course, Kristina Hooper is still with us. Daniel, great to speak with you here. To what extent do you anticipate the pain that we're seeing in the market right now continuing in the second quarter?
Well, I mean, really, if it's just a function of pricing in whatever the tariffs are going to be, once you have an idea of what that hit is in terms of margins, the market should price that in. And then if economic outlook is still positive, you really would anticipate stock prices to go back up. So we all know the uncertainty around the tariffs, but once you have a number, you can price that in, adjust your earnings expectations, but the trend, we think, will still resume to a positive one.
But there are other headwinds, right? In particular, what we're seeing is consumer sentiment down dramatically. Do you think that's going to turn around, or should we be worried about the consumer names, many of which have already come under significant pressure?
Well, I think the challenge today with a lot of the sentiment or soft data indicators is perhaps not quite as reliable as they used to be in terms of predicting what's going to happen in terms of actual demand. So I agree, you've seen big numbers, negative numbers, not only for consumer demand, but looking at business sentiment, small business sentiment, CEO optimism has also taken a big turn down post the election. We just have to wait and see, I think, to how much that actually translates into reduction either in consumer activity or business investment. And I think we really do want to take a wait and see approach on that before reading too much into the numbers that we've had recently.
And you said that we've seen self-reinforced panic selling that you expect to reverse. Help me understand what reverses it. Is it clarity on policy from the Trump administration? What exactly will bring this market back up in your view?
Well, I think fundamentally, if we think about particularly what drove the market at the beginning of the year, when really tariffs weren't so much a theme, even though that seems to be dominating everything today, I think it was much more about a slowdown in economic activity in the U.S. that, frankly, we thought was going to happen. If we recall the view we had for 2025 before the election, all we were talking about then, of course, was soft landing, which was implicitly a slowdown in economic growth. Now, what changed with Trump's election is we thought we would stay in that U.S. exceptionalism, very high U.S. growth for a while longer. And I think it's really that assumption that turns out to have been mistaken. But then when you think about it, that if it's really just going from a 2.8%, say, GDP growth rate to something closer to lower twos, well, yes, you need to adjust your earnings expectations downward. Stock prices are going to reflect that. But once you've done that, you really would anticipate that things rebase and move back up. And that's what we anticipate.
Daniel, is it just tariffs, or should we be worried about government spending cuts as well and the kind of ripple effects they could have for the economy?
Well, certainly there's a lot going on with the Trump administration, some of which is without question going to have a marginally negative impact on growth. Other stuff we do hope will have a positive impact on growth. So it's really the net balance of all those different factors. And if you think about the initial reaction of the markets post the election, knowing that tariffs were coming, you still saw markets rally, believing that the aggregate of all these factors would turn out to be positive. We still are anticipating deregulation. We do anticipate improvement in M&A activity. All of that should be positive for growth. And remember, eventually tariffs, even if negative in the short term because of the increase in prices, should drive a reorientation of demand towards domestic producers that also should eventually drive an increase in investment. So it's a balance of all those factors. So yes, you do want to worry about the impact of reduction in government spending. But if you think about the impact on debt levels, I mean, really what you then should see is a crowding in of private sector investment that can make up for what now should be a reduction in the government share of economic activity.
All right, Daniel, we got to leave it there. Thanks so much for joining us.
Pleasure.
Coming up, we're breaking down the turnaround plan at Intel that's proposed next on Catalyst. Intel's new CEO, Lip-Bu Tan, saying shareholders and customers deserve better at an event this week. Here with more on the planned turnaround for the company, Yahoo Finance tech editor Dan Howley. Dan, what are you looking at?
Yeah, Maddie, this is one of the companies that is truly in need of a turnaround more than any other. Intel is struggling mightily. Their share prices are off 50% over the last 12 months. They're up slightly year to date. That's largely because of the news that Lip Bhutan is the new CEO. During his speech last night at Intel Vision 2025, he basically laid out how he thinks he can turn the company around. And a lot of that has to do with admitting where they've gone wrong. And he said basically that they've let down their customers and they need to improve and that they will. He said he knows that this is a difficult task, that they've fallen behind on innovation, but that they're going to redouble their efforts in bringing back talent to help build back its foundry business as well as its R&D, and that's something that's very important to him. He also touched on Intel's 18A chip as well as Panther Lake. 18A is that chip that they're hoping to ensure they turn themselves into a third-party foundry for customers, basically meaning that they would use 18A for customers like Microsoft or Amazon to build their own custom chips. He also touched on ASICs. Those are the chips that are customized integrated circuits that companies can use for their particular needs, whether that's AI or something else, and saying that they want to be able to get into that. But this is a company that has really struggled to meet the demand for the AI race. They've basically just kind of fallen out of it at this point. They're working to regain there. And then they need to pull back into the PC space. They're losing market share to longtime rival AMD as well as upstarts like Qualcomm. And so that's something that he also touched on, ensuring that they offer the best capabilities in PC as well as AI. And these are the two big tasks that Lip Bhutan has in front of him, not to mention turning that foundry business into a money-making venture and not something that just eats up the balance
Cupcake of a job.
Yeah,
you know,
easy.
sounds easy. Sounds
Just
easy. Dan, thank you so much. Really appreciate you breaking that down for us. We're going to stick with semiconductors here because Bloomberg is reporting President Trump's Commerce Secretary Howard Lutnick considering holding back on funding from the CHIPS Act in order to push firms to invest more in the U.S. without additional subsidies. Lutnick also saying he wants more companies to follow TSMC's plans to add an additional $100 billion in the U.S. on top of its initial $65 billion investment. According to the report, Lutnick's office is weighing a potential 25% tax credit for the chip makers. So, Kristina, it's kind of a carrot and stick approach, I guess. You know, we'll pull back on some subsidies, but then we'll give you this tax credit potentially. And I think it's all, as I mentioned, in an effort to increase domestic chips production, which, of course, is something this administration is keenly focused on.
I think it makes sense. I mean, what we've seen is an incredible amount of spending on manufacturing construction as a result of the CHIPS Act. That's been stimulative for the economy. What this administration wants to do is just encourage co-investment, which is never a bad thing, to have skin in the game. So I think a carrot and stick approach works, but I think abandoning the CHIPS Act would be a mistake for national security reasons and just for economic reasons.
And this new executive order from the president also aimed at making it faster to kind of get shovels in the ground once those subsidies are offered. I do want to stay in the tech space. Quickly want to mention Mark Zuckerberg trying to enlist President Trump to fight against Meta's EU ruling, the EU trying to take away part of what Meta is making a lot of money from, which is ads on its platform, saying consumers should have access to content on these platforms for free. Mark Zuckerberg enlisting the president for some help in that effort here. You can see Meta stock up about 1% as we are seeing a little bit of a rebound in some of the tech stocks today. I want to thank Kristina Hooper of Invesco for joining me for the hour. Really appreciate it, Kristina. Great insights for you. Coming up here, we've got wealth dedicated to all of your personal finance needs. Our very own Julie Hyman has you for the next hour, so stick around for more.